All right, team. It's Monday, 2:10 p.m. I'm going to try to do a video here. My hay fever is going crazy, which tells me the weather's changing, which is weird because it's getting really hot. Normally, this comes in when it gets really cold. So we'll see. We'll see what happens there. So I don't have good news today. And I have a red shirt on, which makes me a jerk because we know I'm supposed to wear green shirts on days that we need green candles in the mortgage bond market. And here I am wearing a red shirt on a day where we're getting our butts kicked again. I'll tell you, there's a few things that are interesting about it. Important things to note if rates matter to you, whether you're an agent or a buyer or refinancer. Rates have not been hit as hard as it looks yet. I don't know why. So, like for example, here, let's look at the charts because you really have to understand what I'm seeing here to know why. This is alarming, yet doesn't seem to be making a huge difference in the actual rates we're quoting people, which is so bizarre. But I'm going to talk about that, why that might be, and kind of what we need to look out for here. Okay. So here's where we are. This is the intermediate cycle going back to mid-May. So we're looking at basically a 3-month time frame here. So this last 90 days. Low point was right here. That was Fed day when the Fed came out and said, yeah, we're probably going to taper sometime soon. And since then, we've had a nice run higher. This is good. Remember, we want mortgage bond prices to go higher so that interest rates will go lower. Well, this is the last 5 days right here. And so you know what that means. No bueno. Now, what in the world's going on? Let's rewind this. Remember what I said on this day after we had this candle right here. I said, hey, the last candle we had that looked like that was this one. And look what happened afterwards. Well, that was our warning. That's why I told everybody to lock. If you are someone who's reached out to me to refinance and I was harassing you about locking, this is why. Trust me, I don't need there's no business that I'm so hungry for that I'm going to lie to somebody, ever. Don't need it. My whole business model is predicated on bringing the truth and, telling you, hey, this is what's going on. This is what you should do. And you can see we had a lock alert that day as well. That was issued by Barry B, who runs this website, mbshighway.com. If you want access to this data, you can go join mbshighway.com. Pay the fee and you can get the stuff. This chart you can't find on CNBC. It doesn't exist. You can find bond charts and stuff, but not mortgage bonds. You can't get this data anywhere else. So that's part of the reason why I'm sharing it. So we have another day we're down 20%, and they put lock alerts the last 4 days because each day they saw it rolling over. And here's the bad news. The bad news is we broke below the 200-day here. That was on Thursday last week. Then Friday was just a total bloodbath. This candle right here. Awful. 37 points down. Very bad. Very bad. Because not only did it break through the 25-day moving average here, which we were already below the 200, which was really supposed to be our support level. If we were going to be really bullish, we would have bounced off this 200 higher. And that's kind of what I was really hoping. Remember when we got up here, I was like, oh, okay, we'll come down to the 200, and then we'll go higher. That would be the best, most bullish case. But I also said, hey, a 50% Fibonacci retracement could also still be bullish. Well, if you look from the low here to the high here, the 50% retracement was pretty much right at this, just right under this support level here. And until the very end of the day, that was the low for today, was right on that Fibonacci. And I said, okay, if we can stay above that, I can stay bullish on bonds. We broke below it, and we closed down here. So it's not a good-looking chart for mortgage bonds right now. Not a good-looking chart. It looks like it doesn't look like the trend has changed. If you'll notice, in the run up, even prior to, it was 1, 2, indecision day, 3 or 4 days. Here is 3 days. Here's a couple of days in the red. This is now 5 in a row, including I would say 3 big ones. And that's back to back to back the last 3 days. Thursday, Friday, Monday, bad, bad, bad. However, I'm still quoting great rates this morning. And I don't understand it. So I really don't know how that is the case unless the banks had already buffered in this move. How could they know this move was going to happen, though? I don't know. So although we've had this 50% retracement from this beautiful run higher, and it has affected rates, it appears to be mostly affecting lower credit score borrowers. So when we say lower credit score, what do you mean? 720 and higher is really where there's a line drawn in the sand. And for some programs, even to 680. You get below 680, we're going to call that a lower credit score because the average credit score in the nation is about 686. So if you're below average credit score wise, you're getting hit mostly for this. And it seems like the higher credit scores, the rates are still really good. Or at least they're not being impacted by a 1-for-1 on what we're seeing in the market. So bad action here, team. Not good. Not what we wanted to see. But also, it could be worse. It could be worse because banks could be actually pricing ahead of it, expecting more downside. Instead, it seems like they're pricing behind it, or maybe pricing ahead with a very bullish outlook. I just don't know how you could be bullish with this. Like, we're almost certain to come down to this tomorrow. We're almost certain to lose another 30 basis points tomorrow. So lock them while you can, team. Lock them while you can. All right, let's take a look at a couple other things here. Stocks pretty mixed today. NASDAQ still doing its thing. Russell S&P and the Dow Jones all down, but small amounts. Oil, we should look at bonds more. 10 years at 132. 10-year at 132. I still expect that thing to get to a point, but we'll see. We'll see. I'll talk more about that later as some things come up. Oil now down in the mid-60s. And a lot of this is based on the idea that there's going to be a potential another lockdown. It's already happening in other countries, by the way. They're doing vaccine mandates, the Green Pass, all that stuff that's happening in Italy, France, major protests, enormous protests, the biggest ones I've ever seen in my life in those different places. So remember, oil is a global thing. So if there's going to be a lockdown, especially a global one, then there's going to be concerns, and these are future prices. So, they're going to get hit by this. It's a good chance to pick up some of those stocks though that we like Chevron, Exxon, or just by the USO. Gold getting stung. Ouch. I don't mean to make fun of people who don't like gold or who like gold and invest in it. But it's just one of those things that makes no sense, in my opinion, to invest in at this point in time. Sorry, Robert, I rolled the wrong shirt. What am I, I've got the red, white, and blue on, though, today. I promise you that. So gold stung a little bit, is what it is. I don't really follow these other guys. Crypto, though, doing really well. Bitcoin here up to 45,000. Ethereum over 3,000. XRP hit 80 cents today. So these are all doing really well. And it seems like we're kind of back to what makes a lot more sense in a hyperinflationary environment. Bitcoin should do extremely well with inflation. In fact, Bitcoin hit 46,000 today. It's down to 45 now. That's kind of normal for Bitcoin. It's all over the place, but at the end of the day, it is designed to go higher. Literally, the way that Bitcoin is designed, the thing of Bitcoin, the design of Bitcoin, the architecture of Bitcoin is so that it will go higher, especially in inflationary circumstances like we have today. A couple things I want to show you here. So we know that not all of the stuff you see in the media is true. A lot of times it's propaganda, or it's a paid for article, or it's something that is written in a certain way to deliver a certain point and not really the full, honest, transparent truth. Well, this was interesting because this article says the senators have a deal on the crypto amendment and the Treasury won't oppose it, which seems very positive for Bitcoin. And I think that could be one of the reasons why we saw it run up to 46,000 earlier today. Key points: Treasury will not oppose. The agreement between two rival crypto amendments is the product of negotiations with the Treasury. Oh, this sounds like everyone's agreeing. But if you read Ted Cruz on Twitter, he says, and this is as of last night, crypto got screwed tonight. There's a partisan disagreement on spending, so the Dems objected to all further amendments. That means no vote on Wyden Lummis to lessen the damage this bill will do to crypto, and no vote on the Cruz amendment to appeal new crypto rules altogether. He goes on to talk about it. Hey, these senators don't know anything about crypto. This is just bad politics. That's going to cause problems. Because Ted Cruz in Texas, Texas is trying to become sort of like the crypto capital of the world, which is a genius concept to try to pull off. But if the federal law causes tax issues, it's sort of how they're blocking it, or at least the leverage that they're using. Politics is so gross. It's just so disgusting. But anyway, that's kind of what they're doing. That's the negotiation that's going on. I liked that tweet right there. I don't think I'm even signed in, but I like this one because it seems like he's telling us the truth. Now, this article makes us think that, well, there was an agreement made and everything's great. But from an actual senator who's there, who's pro-crypto, he's saying wasn't good. And then we see, and this is why I was so interested to see what would happen with crypto, it's pulled back a little bit. Still 45,000 though, moving strong. So which is more likely reality? That's the question. And I will tell you this, as far as real estate is concerned, and this is a really interesting real estate article, and this is the last thing I've got for you. A lot of activity this weekend. People were back on the saddle for sure this weekend. Offers being written, people getting pre-approved, going to open houses, figuring things out. A lot of activity this weekend and continuing activity today. A lot of people reaching out about refinancing today. Isn't it interesting that after a few days of bonds getting shellacked, and I don't pay attention enough to the mainstream media, so this is just me. This could be hyperbole. But after several days of bonds getting shellacked, all of a sudden a bunch of people are reaching out to me about refinancing. Why is that? Do they time their refinance talk in the media to when it's a bad time? Like, what? Seriously. I've been screaming that, hey, we should lock this whole period. I mean, this entire block right here, we were saying that we should be locking, right? Because you get to the tip of that resistance point, and usually it means we need to move the other direction. And that's the 200-day moving average right there. Breaking above it was great, but remember what I said. We've got to bounce off of it and go higher and create a new higher high in order for it to really be on. That never happened. So it was a pump fake. And if you got trapped in here long with bonds, you just got murdered. And that's probably why these candles are so big and so red, because there are probably some bull traps that were set up right here. And, these guys got smoked. Because this is big boy money we're talking about here. You're not getting into this without tens of millions of dollars. So this one, Diana Olix, our favorite reporter, not. Our favorite reporter, no, absolutely not. But, she does give us some stuff, that we can talk about at least. Hi, Gigi. How's it going? Higher rates are better for cash buyers if we can drive prices lower. It's true. Yeah. Higher rates are good for prices to potentially go lower, but we just haven't seen any correlation with that. When we've seen these rate spikes, we just haven't seen prices come down. Not in this cycle. All right, so this is an article. This is two-pronged. This is what I have to share this with you. You need to know this because this is a perfect example of everything I talk about. This is justification for me. This is a victory lap. I'm going to take it right now. How to get in on the booming single-family rental market without buying a house. Wait a minute. Why don't you want me to buy a house? Without buying a house. How to get in on the booming real estate market without buying a house. Why are you telling me this? Why wouldn't I do one of the most basic, fundamental American things and buy a home, which I can then own eventually, free and clear? You're trying to tell me there's something else I should be doing. How could something else be better than that? First of all, it's a terrible headline. Second of all, watch the key points. Small investors, here we go. Now, just so you know, you're a small investor, and that's who they're talking to, you small investors. Small investors who might not have the funds or the stomach to be landlords have a new option to get in on the lucrative single-family rental market. Okay, now notice here they're saying the lucrative single-family rental market. I think that's the only truth that we've read so far in this thing. It is lucrative. So why wouldn't you want to buy a house? They're trying to tell you how to do this without buying a house. Fundrise. Oh, here we go. Here it is. Here it is. This article is paid for by this company. I guarantee it. Fundrise, which started in 2012 as a crowdfunding platform for commercial real estate, is broadening its scope to single-family rental homes investors can get in for as little as $500. So wait a minute, let me get this straight. So this company, Fundrise, pays CNBC to write this article, and as part of their advertisement. It's called advertorial, right? There's editorial content and there's advertorial content. Advertorial is an ad that's made to look like an editorial content. Like I said, I worked in the media. We did tons of digital stuff. That's what they're called. Advertorial content's expensive, but it's very effective because it looks like it's legit content. You can tell by the way this is structured. It just reads like an ad. This does not read like content. Also, the way that they are setting this up is such a sales pitch. Now, what they do, but here's the other thing that's messed up. They're telling you that you shouldn't buy real estate, or if you're, it's not easy for you to buy real estate. This is what you should do: give this company money, so they can go buy real estate with your money, and then once they've bought real estate with your money, they can rent the house to you, back to you, for a lucrative profit. That's what this is. Can you believe this? So you can't buy a house, but give your money to these guys so they can buy houses and then rent them to you in a very lucrative business. Don't worry. You'll get your fractional piece of the pie once we've, taken care of everybody up the totem pole. Not the small investors, but the regular size investors. They get paid first. So, yes, I know. I do victory laps occasionally. Robert. It's not my thing, but right now I have to. I have no choice. I like this. Gigi said this. I'm going to put it up. Vultures are swooping down. They are. And they're coming for real estate. So why would anyone want to do this? Why would anyone want to give their money to a company that's going to go buy homes and create rentals? Well, two things you need to note. Number one, this confirms that there are funds and there are companies, in this case, this one, Fundrise, companies that are buying single-family homes, not just apartment complexes anymore, not just attached, not condos, but they're buying single-family homes to use them as rentals. This is something I've been telling you has been building up for a long time. It's really, really happening right now. COVID was a big spark for that, and it is going to continue for as far as the eye can see. They're now trying to get you to give them money so they can pay you out some pro rata portion based on the amount that you've invested. I can almost guarantee you it's not worth it without even looking at it. Not to mention they're discouraging you from buying a house. Why would you need to go through the hassle? What do they say on here? Don't have the funds or the stomach to be a landlord. Okay, but can you buy your own home first? Should you buy your own home first before you buy an investment property? In most cases, yes, you absolutely should. This is just typical horse hockey. But you know what? If someone wants to look into this and tell me I'm wrong, please do. Look into this. Tell me I'm wrong. This tells you all you need to know. Thanks to a new $300 million credit facility from Goldman Sachs, Fundrise is buying thousands of homes from builders like D.R. Horton, mostly in the Sun Belt. Fundrise manages the homes and offers returns to investors through its fund. So Goldman Sachs already gave them the golden ticket, and they're out there buying houses, single-family homes from builders like D.R. Horton, mentioned on here, from builders and renting them out. So this is going to be a trend that just continues to get worse over time. I can't tell you how important it is to ultimately buy a home. Listen, this isn't a distress call. I'm not telling you if you don't buy a house today, you're falked, okay? That's not what I'm saying. What I'm saying is make a plan, do something soon. Do something in the next 1 to 2 years, because I promise you in 5 years, 10 years, 15 years, the further out we get, the further and further we're going to be from the possibility of buying a house. I'm worried that our kids, grandkids won't be able to unless you buy a house and you can give it down and you can hand it down to them. The trouble is, as parents, we buy one house, we live in that house, we have 3 kids. So now you have to buy 3 houses so your kids can now have a house? I mean, that's the trouble, right? Eventually, there's a problem that you run into here. And teaching your kids about investing in real estate is super, super, super important. It should literally be the only thing on their mind, the first thing they think about when they come into money, when they're trying to learn about money. The first thing you should be teaching them right now is how to buy real estate, how it works, how to shop for it, how to finance it, how to buy it. Get that in their mind. Plant that seed deep, water it over and over and over. Because this is the one thing that may be out of their grasp if they don't reach quickly. Okay, team. NFTs drive up prices. Yeah. Here, let's do some questions here. Goldman Sachs. Yep. Goldman Sachs was involved in 07, 08. They actually made a lot of money, though, on the mortgage meltdown. See, Goldman Sachs is completely intertwined with the government and have been for a very long time. They know what's happening long before anyone else does. Although they were a little late to their short position, they made a tremendous amount of money shorting the housing market and shorting companies that were attached to the housing market. Huge profits during the crash in 07, 08. So they're just a money-making organism. That's all they care about. Good question, Gigi. This is true. They're building portfolios. There's no question about it. Prices will be driven higher as a result. There's no doubt about it. 28-year-old son. Yeah. Hey, listen, it's never too early to teach him about this. I'm teaching my 14-year-old how this stuff works. It's never too early. Smartest thing to do is to make sure they understand that this needs to be your priority number one. This is what you're saving money for. This is what you're going to work for. This is what you need to do, because a lot of times the first thing on a kid's mind will be a car. That's very typical. First thing on the mind will be a car. You want your kid to be so well trained that they say, you know what, I'll take your hand-me-down car, or you know what, just get me a junker because I need to save money to buy my house, to buy some property. And it's okay. It's okay. If you need to take a long road, that's okay. Just make sure you're on a road that takes you to owning real estate. And the sooner the better. Okay, I understand not everybody can do it right away, but do it sooner rather than later. It's stuff like this that just reiterates what's happening. Wall Street, in short, Wall Street will buy all the houses as soon as they have enough money. They'll buy them all, and they'll rent them, and they'll control the prices, and everyone will be in a really bad situation when that day comes, unless you own a home, and then it won't matter because your payment will be fixed and you'll be okay. Now, that day could be 20, 30, 40 years from now. I don't know. It could be 5 years from now. I don't know. All I know is they are buying money. New funds are being created. Funds like this one, Fundrise. These kind of funds. And this is a crowdfunding platform that was actually started almost a decade ago for commercial real estate. They're broadening their scope to single-family rental homes. So just think about that. It's so lucrative, which was also mentioned in here, that other types of financing and fundraising arms are reaching into it. And they're buying homes directly from home builders, brand new homes, to rent them out to people. So it's happening, team. It's happening. It's in place. Let's be smarter than everyone else. Make a plan. Let's go. And if you want to talk about this stuff in more detail, if you have questions, want to buy, want to refi, give me a call, shoot me a text, send me an email, and I'm happy to help. You guys have a great day, and I will talk to you soon.